Hi everybody, looks like we've gone live. Sorry for the delay there. I haven't got the headset on today, so I really hope it's helping there. It's great you can see me more easily, and hopefully the sound's coming through loud and clear. Now, I did see a comment coming in through there from Jerry. How are we going? Let us know in the chat box there. Is it coming through loud and clear? I really hope the new microphone is making a difference, and look forward to running this with you here today. All right, well let's get into it. So let's move over to the next screen there. I'll just click there and it should transition across to the next screen. Let us know we're coming through loud and clear and you can see the picture. All right, good. So let's get into it. So identifying the highest yielding stocks in Australia that are the most reliable. And welcome, you saw me on camera there before. Let's just put it back again, just an introduction. My name's Russell Markham. I'm the Director of Education for VectorVest Australia. I've been at VectorVest now for over 12 years, and I really love educating people on how to find great stocks around the world. And one of my favorite topics is finding those top high dividend yielding stocks. I'm going to show you just how quick and easy it is to do today. It's a fun exercise we're doing today. When I woke up this morning, I thought, yeah, I'm really looking forward to the webcast today because it's one of my favorite topics. And you'll see why shortly, because it's so easy to do. All right, so let's do this. Sorry, got to turn my head there. Move the screen across. So here we go. I'm now showing you the main screen here, and let's just quickly get through the disclaimer statements here. So you can see our license number there, and you can also see more per our web page. In addition, please note today it's general advice only. I cannot advise on your personal circumstances. And as noted here, past performance is not a guarantee of future results. So any forecasts or backtests used discussed in any of our presentations there may be affected by known or unknown risks and uncertainties. Okay, and they may therefore differ materially from the results ultimately achieved. So finding the highest dividend yields, we will turn to UniSearch to do the heavy lifting for us. So what do I mean by that? In the VectorVest system, I'm going to jump out of here. Let's jump out, minimize that. So once you've logged into VectorVest, so if you take out a trial, then today I'll show you where you can take out a trial should you choose. Noted over here, if I could increase the recording volume, how's that? Is that all coming through nice and clear? It should hopefully be nice and loud. All right, so hopefully you're hearing it nice and clearly. So once I'm in the VectorVest system, what I'm going to do here is I'm going to use this tool called UniSearch. Now, UniSearch saves you a lot of time as an investor. Saves you a lot of time. The reason being is because UniSearch will do a lot of the heavy lifting for you. So it'll pick up certain things that you're looking for rather than you having to go and find them. So what do I mean by that? So in the UniSearch tool, we've got this search here, this group called Searches Retirement. Okay, so Searches Retirement here will find us different attributes that retiree investors are looking for. In this particular case here, I'm going to pick on this one here called high growth dividend payers. Okay, so high growth dividend payers. And you'll see over here, VectorVest is going to go through all the stocks that we track each and every day. So on here, just to give you an idea, 2,084, it includes LICs, ETFs, stocks. All right, ETFs are pretty popular these days, so it includes all that. And it goes through all of these stocks, LICs, ETFs, you name it, and it'll find those stocks, and when I say stocks, it includes the LICs and ETFs, and it finds it where the dividend yield is 2% or higher, where it's a buy-rated stock, so good fundamentals and technicals on average, and the dividend growth, the company's looking to grow its dividends by at least 20% or more. All right, very attractive in its own right. So if you run the search there, and you'll see it's pretty strict, and you'll find all those stocks that meet that criteria. You know, so here you can go straight away and go, okay, well, I know immediately that I'm going to find a stock where the dividend yield, I'll just pick on this one here. So dividend yield is at least 2% or better. And you'll see all these shares here are also rated, what we call buy rated. So on average, they meet some pretty strict fundamental and technical criteria. And then these companies are also going to look to grow their dividends by an astounding, over here, this is the dividend growth column here. I'll just right click auto fit all columns, make it nice and neat. But this is your dividend growth. All right, I've just on record mode here. I can't stretch it out, but looking to grow their dividends by at least 41% or more a year. So if you're looking at a company like this, Beta Share Climate, it's not only paying you a dividend of 2%, but looking to grow it by a whopping 41%. All right, it's a good starting point. Now, in preparation for the live broadcast today, I wanted to show you a technique that works really well for me. So this is something that I do. This is a pretty strict search, and you get a handful, but I'd like a few more. It looks like we've got about 15 or 20. All right, so what I did here is I said, well, let's take this as a starting point, and all I'm going to do here is I'm just going to click where it notes 2 and click on custom value and change it to say 3. Find me those juicy dividends of at least 3% or better. Now, if I'm getting a dividend of 3%, I'm quite happy if the company's growing its dividends by 10%. So 10% on 3, take me close to 3.5%. I'd be pretty happy with that. All right, so if that's the case, so all I've done here, I've just bumped it up to 3, and I've just said, make sure the dividend growth on those dividends at least 10% or more. The reason I've done that, I've just changed it just ever so slightly, is because now I've got quite a few more that I can consider. All right, it makes life good because now I've got quite a lot I can effectively consider. So what I'm going to do here is I'm going to select all these and put them into watch list. All right, so just click on the first one here, hold my shift key, go down to the final one there. So I've selected the full tranche. I'm going to right click, and I'm now going to select add to watch list. Now don't get caught up on the functionality. It's pretty easy once you get to grips with VectorVest, and we've got tons of training videos. We've got a support team on a 1-800 toll-free number for Australia, and the team can help you with all this. It's more the methodology I'm showing you today. So what I've done here is I've already created a watch list called high dividend payers. So last week we built a growth and income portfolio, remember that, a watch list, and we also built an income portfolio. I'm actually working on this one here, top 3 dividend payers, all-time dividend payers over the last 10 years. But today we're concentrating on here. So the highest dividend payers, I've created this watch list already, and I'm going to push OK to put the stocks into that watch list. Now again, in the first hot topics of interest, we worked through how to set up a watch list. Don't worry if you missed that. You can watch the recording, and don't worry if you've forgotten. On the welcome tab here, we've got a tutorial how to build a watch list. Okay, so today I didn't want to get caught up in going through how to build a watch list again. I just want to cut to the chase and show you how to find those top dividend payers. All right, so here we go. I've put all those in now to watch list, and you can see a whopping total of 62. Now we, of course, not going to go and buy 62 stocks. Certainly, I think the average investor out there wouldn't want to buy a third of that, but it's a good starting point. We've picked out some of the juiciest dividend payers in Australia in this list, and now we're going to refine it. So if I have a look just down, this is the average of everything that we're tracking here. You can see that the average yield is a whopping 5.17%. And if I scroll over a bit more here, I can see that the stocks on average are about 40%. The interim franking credits are 40%, and the final franking credits are 40 odd percent. Oh yes, and Andrew's noting, yes, much better volume, thank you. Great. So I've just pulled the microphone very close to my face now, so great to hear. Okay, so here we go. We're going to refine it. I think we can do better. Certainly the yield's very attractive. I'd like to get the franking credits up a bit, and let's just look at what the average looks like. So I'm just going to right click down here and look at the average to begin with. So it's a good starting point, and I've put on a couple of key indicators to begin with. Remember last time, the first hot topics of interest, we spoke about the all importance of rising earnings to drive our portfolios. You can see it's a pretty decent set of earnings, but a little bit it's not as strong as it could be currently. So there's a bit of work to do on improving those earnings, and also the overall portfolio has not been very good across those stocks. It's got beaten up quite badly in recent months. We can do better. All right, so that's our starting point. So just a quick recap: we went to UniSearch, I went to Search as Retirement, I picked on the high growth dividend payers, and all I did here is I just changed this one here, custom value, and I put it to being 3 because I just wanted it a little bit higher than 2. And just to find a few more stocks, instead of the companies growing the dividends by 20%, I just dialed it down to 10%. I ran the search and I took all of these stocks and I moved them over into a watch list. All right, so here's that watch list. Right, let's get into it now. So first thing up, what I'm going to do here is I'm going to pick on this indicator here called dividend safety, DS. It's on a scale of 0 to 99. In Australia, if you can get a dividend safety score like what we covered last week of 50 or better, then you're dealing with a very strong company from a dividend reliability perspective. And if you look down the list here, although some of these companies are looking to pay a pretty hefty dividend, you can see that there are one or two where the safety scores are not very good at all. All right, you can see, like, for example, Horizon Oil, they're looking to pay out a dividend of 18%, but they've got a 0 dividend safety record. Why is that? It's because they're not making enough earnings to meet that. The earnings that they're making is 5.88. They're looking to pay out 18%. So the question is where you're going to get the money. You're going to have to borrow. Are you going to cut the dividends? What's going to happen? So hence that's why the dividend safety is being impacted. So it's got a 0 out of 99. If I look at the company here is its earnings. Let's pull it back over the last 7 years, and you can see that the earnings have been trending downwards. You can see over here from there onwards, there's been a bit of a. Let's see here. Draw a freehand line. No, am I not drawing it? But you can see here. Sorry, not drawing it. I wanted to draw in a freehand line here. But you can see there. You can see those earnings have been tracking sort of downwards. And that's not good for a company if earnings continue to sort of flatline and fall away. It's going to impact upon the ability to meet or exceed dividends. Although the share price has gone up, there is a question mark behind the earnings at the moment, and the earnings yield that the company is making to meet those dividends, 5.88 versus 18. So there's a question mark. If you come up to the top end up here, and you pick on, say, someone like BlueScope Steel, they're earning 11% to pay out 3. Plenty of petrol in the tank to go the distance, so to speak. If you look at Yancoal, they're earning 41 cents or 41% to pay out 19%. So if you might look at Yancoal and go, my goodness, are they going to meet 19%? Well, they've certainly got the earnings up their sleeve right now to meet that. And if you were to graph, say, Yancoal, look at its earnings profile compared to what we've just seen with sorry about that, just something's popped up there. What we've just seen with the oil company. All right, much more solid set of earnings. Companies with solid earnings are companies that are able to meet or exceed dividend expectations. Here's the actual dividends. Look at the correlation here. If you put on the dividends, all right, so if you put on the actual dividends, let's change this and make it a different color, and I'll make that jump out a tad more. See the correlation here. All right, you've got rising earnings, rising dividends, and we're seeing that time and time again. If you want those high dividend yielding companies, make sure that they're growing their earnings. Okay, so with that said, what we're going to do here is we're going to remove anything where the dividend safety score falls below 50. So the dividend safety score is looking at whether a company can meet those dividend obligations. So to bring up the definition here, so we've covered the uni search today. All right, so that was the one where we went to the high growth dividend pays. We've changed that to a 3 and dialed that down to a 10 to get more stocks. We've looked at dividend yield. So if you're new to investing, a dividend yield is just simply the dividends looking to be paid out in dollars and cents divided by the share price times 100. And that gives you the yield. What percentage of the current share price is being paid out in a dividend? And that's the dividend yield. So this is one we're going to screen by, dividend safety. It's an indicator of the assurance that regular cash dividends will be declared and paid at current or at higher rates for the foreseeable future. All right, so this is what we're going to pick on. Can we find those top dividend paying companies with a dividend safety scores at least 50 or better? So Australia, it's 50 or better. So here we are. So from here onwards, if I scroll down here, I'm going to remove all the dividend safeties. So all I did here is I'm just sorted by dividend safety, and I'm going to take out anything where the dividend safety is below 50. All right, delete selected. So we'll chop it back. We've got 62. We've chopped it back to 37. All right. Now again, I don't know about you, but I certainly wouldn't want to go and buy 37 stocks. It's still too many, but it's a good starting point. Let's look at the average of all those shares. So we're on our way now to whittling it down a bit more. Earnings are still a bit sort of lackluster. They're not that great. We can do better. The dividends paid is holding steady. Let's look at the yield. Yield there at, what's that, 4.98. And the franking credits are now about 25%, 24% sort of franked. All right, we can do better. All right, so again, we're refining it. Let's continue to refine. We spoke about the importance of earnings. So if a company's growing its earnings, it's in a better position to meet or exceed dividends. We've got this powerful indicator here called GRT, earnings growth rate. So it's looking at what a company is looking to grow its earnings by. So Yancoal's currently looking to grow its earnings by a staggering 36%. No prizes for guessing why they're able to meet or exceed dividend obligations, and hence they've got a very good safety score of 64 out of 99. A safety score of 60 or higher is excellent in the Australia database for dividend-paying stocks. All right, so what we're going to do here is we're going to remove any dividends here where effectively where or dividend-paying stocks where the safety score is below 50, which we've done. And now what we're going to do is we're going to remove anything where the earnings growth rate, all right, where the earnings growth rate is below 0. Okay, so 0 or below. Now some of these are ETFs, so we cannot work out what the earnings growth rate is, but we're going to remove anything where the earnings growth rate is below 0. How about that? Okay, so here we go. I'm going to right click and I'm now going to delete items. Okay, so here we go. And I'm taking them out. So yeah, and as Mark notes there, a lot of ETFs will be deleted with low GRT. Absolutely. So any ETF in the system we give a 0 GRT to because we cannot calculate it. I'm being very conservative here in the fact that I need to know what the earnings growth rate will be. ETFs you cannot tell. There's no published information that we can take and work with to give us what an earnings growth rate will be. So an ETF in that respect, you're unable to ascertain that. So for this exercise, I want to pick on stocks where I can actually see what the earnings will be. Okay, so or at least and the forecasted earnings as well. So here we've got an earnings growth rate of above 0. So again, what are we down to? 16. So getting closer to a number to work with. Let's right click and let's look at the average watch list again. The earnings starting to improve. It's looking a little bit better now. Still a bit of work to do, but it's certainly a bit smoother. We're going to smooth this out a bit more. And at the moment we're at a dividend yield now of 3.97%. And look at that, the franking credits are coming up to around about 55% on average, both interim and final. So it's improving a bit. We've got more work to do. All right, so we close out of here. We've whittled it down to 16. Now let's refine this a wee bit further. Okay, so what I'm going to do here now is I'm going to be pretty strict. I'm going to say, look, at the moment inflation is what, 7 to 8%. The growth rate 9.71. It's barely keeping up with inflation. So I'm going to take these ones out for now. So remove those ones out. So just refine it up a little bit further. Just being a little bit stricter on the growth. Okay, and then if I look at the dividend yield, 4.1. It's pretty attractive. There's nothing wrong with the 4%, but we're dealing with the best of the best at the moment. And let's be a little bit more selective on the dividends. So coming down here, I might say, well, there's one or two where it's a tad below 4, so I might just chop these 3 out here. Nothing wrong with these, but I'm being pretty fussy because I'm wanting to get, as the webcast notes, the highest dividends. All right, so here I've chopped it down and we can see the average dividends now. If I scroll across, the average dividends here, 4.25. So we've got the yield now to 4.25. All right, let's view the watch list average. Let's have a look again. Very nice set of earnings. Wow, look at that. This is good. This is what I'm wanting to see. I'm wanting to see that share price coming up, which is good. Yield of 4.26. Interim and final franking credits 56 and 61. So about 50 odd percent franked. And we can see the growth rate, although it's sort of slipping away, but it's still at a whopping 20 odd percent. That's very good still. All right. So we're getting closer. We're getting closer. We've got 10. Now the final check and balance that I'm going to do here is depending on what you're after. But one thing you can do here is just to eyeball the final 10. And here we're going to weed out any stocks where, I'll just take a line I've drawn on here, any stocks where it's not sort of stacking up from an earnings and price perspective. What do I mean by that? If the earnings look like they're coming off and the price is quite ragged, we might remove those stocks. So Yancoal here, a little bit of a tail developing on the earnings. I'm not overly concerned just yet, but it might be one that gets removed. All right, ASG, it's okay. Earnings holding up, share price coming up nicely now. All right, IGL, yep, it's okay too. Earnings holding up, price going up, good. All right, I don't know about you, but I need a bit of information, a bit more valuable information than just simply a couple of months here. DDH, to me, it's, I need more of a track record, so I might remove that one. ACF, brilliant, great earnings, and as you appreciate, you'd see that there's your dividends going up in combination with the earnings. You're seeing that correlation, and again, you put the dividends in dollars and cents, surprise, surprise. It's just a right click here, change type area, and change the color. I'll make it stand out a bit differently. All right, but there's that correlation again. Your earnings, yep. So that one jumps out. All right. So on here again, SLH. No data exists prior to sort of October 21, around about here, July, October. So again, if you're conservative, you probably want to drop that one out. You want at least, I would say, 5 years worth. Okay, RWC, look at the share price falling along with earnings, and you can see dividends have started to flatline. So that's a bit of a warning for me. And GUD, look at that, dividends are sort of bouncing around, earnings are sort of starting to taper off, share price a little bit scrambled at the moment. So, you can be forgiven for wanting to clean that out as well. This one is pretty good. Earnings sort of holding steady, and look at that. Look at those earnings powering on. All right. So if I come back on my list here, my final list, which were the ones that I took out. So YEL, just based on the final eyeball of each one. DDH, SLH. I'm being really picky here because at the end of the day, it's your money, and you want your money to work as hard for you as what you work to earn it, right? So here we go. So out of the entire list there in Australia, I've broken it down now to 5. And if I come down to the bottom here and right click and view the watch list average, here are the final 5. All right, pulling back here, dividends and dollars and cents. I'm pretty happy with that because at the end of the day, although this can bounce around a bit, ultimately this is what I'm after. All right, so you've got a great yield there. Currently 3.78, so just shy of 4. All right, and then your franking credits 68 and 60. So you've got a very robust set of earnings there, driving both the portfolio and driving and making sure that the yield is holding up too. So just shy of 4%, you factor in your franking credits, it'll be just over 4%. And it's robust because those earnings are super robust. All right, there's the growth rate. And look at that, the growth rate there is holding steady. So there you are. It not only had to be high dividend yielding, but it had to be, as we noted, reliable high dividend yield. All right, so there you go. There are those. I've managed to whittle it down across all the stocks there that we track in the VectorVest system, down to 5 that jump out. Now again, the final bit of proof in the pudding and the eating as such would be, would you be comfortable with those stocks? So this is $2 stock. This is a penny stock. So not everyone would necessarily like that, right? 78 cents, 79 cents. And this one, $190 stock. But the average price across all of those stocks there is $39. All right, so there's plenty of liquidity as well. The other thing is when you're looking to build, high dividend yielding type stocks sets in a portfolio, you need a lot of volume as well if you're going to be looking to invest a bit of money. So again, what you'd want to do is you'd want to come in here and look at your shares, actually price volume. This is what you'd want. The average 50-day moving average traded per day. Would it stack up? So, there's an average of 301,000 shares traded a day across these stocks. But at an individual level, just want to make sure you've got your liquidity there. I come in here, the average volume, so I can see ASG, 32,000 traded a day on average, 249,000 for IGL, 281,000 shares traded a day for ACF. All right, 312 there for LAU, Lindsay, Australia, plenty of liquidity, and a whopping 632,000 shares traded a day for Macquarie. So again, it meets the liquidity checks and balances that I'd like to put in there as well. So let me know in the chat box, what do you think? There is a yielding set of stocks there, just shy of 4%. Factor in your franking credits, and you're over 4%. The earnings across those companies are 6.2% to pay out just shy of 4%. So plenty of earnings in the tank, petrol in the tank to go the distance. And again, let's look at the all-important dividend safety, a 57 out of 99, which is just shy of an excellent rating. All right, so if I put those onto the graph just to show you them as well. So let's have a look at those dividends. Let's add them in. So add, and we'll put in dividends here. We'll put in dividend growth. So these companies are looking to look at that big uplift in the growth, but you can see the growth has averaged, well over, what's it over the years there? There's 3 years worth. This was the sell down with COVID, but you can see there it's about 10 to 12% on average. So that's good. That's what we want. Dividend safety. There was a COVID sell down, but prior to that, it looks like it's averaging well over 50 dividend safety on average. All right, so there it is. Pick on those companies growing their earnings, and then pick on the companies that are paying dividends with the growing earnings. All right, to make sure you're getting the yield that you want. And then you'll see time and time again, as we've seen over the years and as I teach it, you'll see that strong correlation between dividends being paid. This isn't dollars and cents, and earnings, and you see that time and time again. You see that correlation. Rising earnings, rising dividends, they hold steady. In this case here, it's sort of bounced around a bit, but that's okay. The engine's strong, and the dividends in dollars and cents have been holding strong too, along with the yield. So you're getting about 4% yield. And what's this portfolio gone from? It's gone from $24 back in June of 2020 to over, what's it now? Just shy of $40 odd as of current date, as of close of business yesterday. So you're getting growth here as well. So ironically, this is also a growth portfolio, and you'll often find that growth will be strongly associated with dividends. Companies that are growing their earnings are companies that are more likely to be able to afford dividends. So you'll often see that correlation between growth and dividends. So there it is. And again, you can repeat this exercise again and work it to the way you prefer it. So you might come back and say, well, I'll start it off with 3, but I want the growth of at least 20 or higher. That's okay. Run the search, grab your stocks, drop them into a watch list, and then away you go. Okay, nice and easy, quick and easy, fun to do. I hope you've seen that it's actually quite fun. It's easy to do. So let me know there in the chat box. And comment here. The inclusion of Macquarie skews the average to the upside, but that's the beauty of building a portfolio. Put those outliers in that skew things to the upside. And that's the beauty of building high-performing, dividend-paying portfolios. It only takes 1 or 2 superstars to turn things right around. And you'll often find with portfolios, when you're cleaning them up, it's just 1 or 2 bad apples in the barrel that spoils it. As soon as you take them out, the portfolio improves dramatically. All right, so if you like what you see today, trial out VectorVest. Give it a go. First thing I'd note to you is if you're wanting to repeat this exercise, go to the Welcome tab and click on the watch list tutorial and go through that. It builds a watch list for you. So you get to grips with building a watch list. Then come and do this exercise. Click on Uni Search, open up the search as retirement, open up the high growth dividend payers, tweak any of the parameters here to your liking, run it, get all those top dividend payers, move those over into a watch list, and then clean up the watch list like I showed you. And if all you want to do to make it super simple, if all you wanted to do was, I'll take this out, I'll go back to Uni Search. Let's say I'll keep it 3 and 10 because that works for me, it gives me lots of choice. And let's say all you want to now do was grab them all, right click, add to watch list. And all we're going to do is remove the dividend safety below 50. All right, so there it is, highest dividend payers, push OK. And then I'll go to my watch list. So they're all in here, 62 odd. And then I'll just come into here and I'll just say, okay, remove any stocks where the dividend safety is 50 or lower. All right, so here we are, or below 50, should I say. So it's these ones here, delete, take them out. And then you can keep a watch list. Now you've got a great reference point to begin with. You've got companies where the dividend yield is 3% or better, where the safety track record is strong. So it's a great starting point. And then from there, you can have a look to see how everything stacks up. This, in its own right, what you've got here is pretty powerful. The trend is going up on average, earnings are holding steady, and you can see the dividends coming up with a yield averaging just shy of 5%. All right, franking credits at about 25-26%. There it is. It depends on how you want to cut, slice and dice. You've got so many great tools here. And then what you might do is you might say, well, give me the top franking credits as well. Anything that's fully franked, anything that's not franked, I'll remove out. So this is the final frankings here. And then you've got interim. So you've got to sort of find a blend between the two. And I'll chop out anything where it's starting to get a bit sort of not as many franking credits there. There you are. So there you are. I've just basically kept the highest franking credit stocks and with a dividend safety of 50 or better. So here, if I have a look at that. Interim 100%, final 73%, so pretty much close to fully franked. Dividend safety of 56, dividend yield of 3.74. That's all I did, just 2 little iterations. Here, the earnings have started to turn around, which is good. We're just starting to see that turnaround taking place. Here are those top dividend payers. So there was another quick way of doing it. All right, but that's your starting point. So I hope you enjoyed it. Let's jump to the website there. I've just got to load up VectorVest. So if you like what you see, you want to take it further, you want to trial it out, there we go. VectorVest.com.au, and if you click there on risk-free trial, you can then trial it out, okay? And away you go. So you can trial it out for 30 days and for $9.95 USD for 30 days, called 13 Australian dollars, and see what you think. All right, I'll move the camera back onto me. I've pulled the microphone closer to my face, so thanks for you guys helping me today to work that out. I'm learning to get better with podcasting, webcasting. It's sort of got to get it out of my face a bit. But I hope you enjoyed it. Hope it was fun. Sorry, the camera's a bit crackly there. It's improving. Yeah, so look, any issues, any problems, give us an email. I'll give you my email address to help you out there as well. So if there's anything we can do to help you, feel free to email me through. Here we go. So Russell Markham, I'll make this bigger, at VectorVest.com, and let's blow that up a bit. Sorry, I've got to move the camera across here so you can see it. And there we go. Right, so let's maximize that. I'll just blow it up here. There we go. Drop me an email if there's anything we can help you with. Russell Markham at VectorVest.com. There were 1 or 2 extra slides, but we're having so much fun building those high dividend yielding stocks, but I'll just leave that with you. Remember earnings growth rate. So you want to make sure that you're finding those top growth rate companies. Remove the ones where the growth rate is, say, below 10%. So you can find those real high growth rate companies. And we mentioned it today, but it's worth mentioning it again. Make sure that your earnings yield is covering your dividend yield, because if the company's not earning enough, where are they going to get the dividends from? Okay, so I'll just leave that there with you as well. So there's my email address if you want to drop us an email for whatever reason to help. And there at vectorvest.com.au. Whoop, I think I think there are. It's refreshed. Okay, risk-free trial. Okay, I think the team we're just doing an update on the website there. There is your risk-free trial. So if you want to trial it out and see what you think, you'll get a lot out of it. Believe you me. All right. So thanks again. I'll wrap it up there. Thanks everybody for coming along today. Hope you got a lot out of it. Bye for now.